The scarcity of the US dollar within the Nigerian banking industry continues to dampen some demand efforts for imports and also hit manufacturers even harder as they look out for local substitutes for their inputs. The nation's external reserves dropped by $610 million just last month, according to recent figures obtained from the Central Bank of Nigeria. Now, the reserves dropped to $41.22 billion as of November the 29th from $41.83 billion, which was recorded in October. The CBN also disclosed that at present level, the external reserves could meet the country's 9-month import demand. Well, let's now analyze the impact of this continuous dollar shortage in the Nigerian economy and how well we're faring looking at the cushion, the external reserves. Joining me now in our Lagos studio to discuss this and more, I have investment strategist from Afrinvest Asset Management Ltd, Temitope Omosuyi. Thank you very much for joining us on the show today.
Thank you for having me.
Now, this $610 million drop does not necessarily cause a big stir in the economy. It's not necessarily a huge drop as we had the initial sentiment at the start of this year, whether or not we will see the external reserves bounce beyond the $30-35 benchmark. Now we're at about $41 billion, and it's safe to say we're within a safe threshold. However, we need to look much more circumspectively within our revenue earners in terms of foreign exchange. What are some of the mistakes you think we're making today in an overview of the year 2021, our reliance on oil and expanding the base for foreign exchange earnings?
All right, thank you for having me. So it's quite interesting that we're seeing some kind of movement in the foreign reserves. So I would like to take you back to what happened in January till date. You know, in January we saw about $35 billion. And it decelerated to about $33 billion in August 23rd. And interestingly, you know, on the 23rd, SDR came in from the IMF. So, and in the same period, we had Eurobond issuance. So, putting the two figures together is about 7 billion. So, at 33 billion, add 7 billion, you should expect that.
That was the prop-up we had.
So, it's just 41 billion. So it's not a rocket science. We expected that, you know, it will get to 41 billion before you start seeing the deceleration. So it's not really a shock at all. So, you know, because we are not seeing those one-off inflows, that's why we are seeing the current deceleration in foreign reserves. So if we are not seeing something similar to what we saw in August, then this might continue for a while. And you know, a number of persons that celebrated the increase in foreign reserve as at you know, August into October, you know, is an outlier because Nigeria foreign reserve usually increased by about 15 to 50 million daily, but we saw about 500 million. You know, that should tell you that it's as a result of those one-off inflows. So going forward, you know, our attention shouldn't just be on foreign reserves. You know, foreign reserve is connected to the balance of payment. Balance of payment is the true picture of what you're seeing that's currently happening to foreign reserve. In fact, I usually tell people that foreign reserve is a leading indicator because, for instance, a balance of payment figure is just as at Q2, but foreign reserve, you have it as at 30th of this month. So whatever happens to foreign reserve, it's just like your savings, right? What determines foreign reserve is our savings. What determines your savings? Your income and consumption. So what you should focus on is your income and how you consume to determine what will happen to your savings. Oh, if you are not earning well in terms of inflows into balance of payment and we are getting a lot out of the balance of payment, you continue to see a drawdown on the foreign reserve. And so if we want to address the problem with foreign reserve, then we have to look at the components of balance of payment and put in place policies that will address the negative performance or the drawdown we are seeing in that area.
Well, looking at the performance of our GDP, we saw quite an impressive front in terms of the non-oil sector and the contributions from that. But these are not necessarily foreign exchange earners for the country. We've not necessarily seen a boom in terms of our export as well. Hence, the heavy reliance or the fixation on oil still remains there. But let's also face the reality that come next year, there are already mixed conversations about fuel subsidy. That's one of the reasons why we always have to dip into our external reserves just to keep the economy afloat. If we remove the fuel subsidy, which we always have to cover for, and import as well, reducing that, looking at Dangote refinery also coming to bear, and then that of Boa as well. How do you see us having a bigger pool of fund as our economic cushion the external reserve?
So, well, that's, I painted a scenario that your savings is a function of consumption and income. So, consumption is the aspect of subsidy, right? Which subsidy will help you not to consume so much of your of the external reserves. But we also need more inflows. So, is of two sides. You want to save, you want to reduce your consumption from the aspect of subsidy that is about 1 trillion every year. So we have to look at, like I mentioned, I think the focus should also be on how we will improve our current account balance. That is looking at, we look at exports, look at capital importation. So all of this together, because if we are not looking at the broad component of balance of payments, just by saving from subsidy, though is going to be very, very beneficial, because if the savings you are getting from subsidy is channeled to the aspect of the economy that will enhance the real sector. Because if it does not enhance the real sector, it will net off the impact on aggregate welfare. Because if you are taking savings, you want the other side of the balance of payment, which is export to perform well. It's not all about savings. So, which is why government has to begin to look at how do we put in place policy. Although the CBN has adopted a number of approaches in the past that aligned with monetary policy or economics view on how to address balance of payment problem. And one of the approach is we usually talk about this elasticity approach. The idea is that we usually propose the CBN should depreciate the currency. Although when you hear depreciation,
Naira devaluation is not necessarily the solution to the problem.
Yes, but that is for the layman. I know that, yes, it's not necessarily the solution, but it is used in economies as a short-term measure. And the idea is this, when you devalue your currency and you have a strong, domestic economy that is buoyant, your export becomes cheaper and import become automatically expensive. That will discourage importation. What led to this significant deceleration we saw in 2020 was because despite the deceleration in export earnings, our imports did not go down. So, but with devaluation, you are forced to reduce your export. You must consume what is produced locally. So, which is why I think the little improvement we've seen in balance of payment now is as a result of the of that policy.
Temitope, if I'm important here now, let's look at some reality we have at now. We're speaking about the Omicron variant of the coronavirus. We don't necessarily know how much of an impact or hit would have to the domestic economy and even on the global front. Now, these are still the early days of the Omicron, and nobody can really say for certain how things are going to pan out. But if we have a worst-case scenario, a replica of what happened last year, do you see us having a likely sharp decline in our external reserve base, especially looking at our heavy reliance on external shocks in terms of the pricing of our crude? Because at the end of the day, the moment we have depreciation in energy demand, the cost would also drop as well. How do you see things playing out in a worst case scenario with Omicron, for example?
Well, if the condition gets so worsened that it leads to a significant lockdown,
yeah.
it will affect oil prices. But already, outlook for oil prices is kind of...
There are already concerns around the price of oil prices. We had a 2-day meeting with OPEC and its allies, also looking at whether or not we can sustain this momentum that we are going at, looking at reserves as well, and a whole lot more. So it's quite difficult to really plan.
Yes, the odds are actually against oil prices and other commodity prices at this point, if you exclude the impact of Omicron, because even for the fact that...
I want us to look at Omicron in focus.
Yes,
yeah.
We can look at Omicron because, yes, it's going to affect, but I think there are some positive news regarding vaccination and the fact that, it's not as severe as other variants. And I think those are positive. We are on a learning curve. Vaccine producers, I think they'll be able to do better at this time. And I'm not seeing a kind of the level of shock we saw last year that took oil prices below $40 per barrel. I'm not seeing that for 2022 because I think the world economy and the world health system has
developed a better response
gone beyond
pattern.
that. But the only challenge I'm seeing on the horizon is the fact that normalization of policy is coming on board, and once rates are going up, the implication is that US dollar will be become very expensive, and once that happens, it will take a negative toll on oil prices, because the current rally we are seeing in the oil space is not just actual, it's the combination of actual performance and expectation. Expectation, when you get to that level, that's when we get to 2022, and we see that the actual is not even up to what we expected. It will take a toll on prices, in addition to the fact that I said dollar index will take a toll on oil prices altogether.
And also looking at the lingering forex scarcity, which you've also made mention of in Nigeria as we speak today now. You look at the likes of the aviation sector. We had airlines also being told not to sell tickets for inbound flights into the country just because of the lack of forex. Now, with the allocation we have to banks, that's also another conversation for another day. But looking at the lingering forex scarcity we have at this point in time, how do you see things panning out? The CBN, yes, is trying its best to ensure that we mop up unnecessary liquidity, ensure that we have some sanity in the market. We don't necessarily see broader chance operators have any allocation anymore. How do you see us dealing circumspectively now with the lingering issue of forex scarcity today?
Well, this problem, is, let me say the likelihood for a major turn is very, very slim. Although I know that the CBN is actually doing so much, especially when I check money supply, that is naira liquidity in the system. The CBN, particularly this year, they've tried to reduce it so as to reduce the naira against
and even looking at incentives like naira for dollar initiative.
So in addition to the LDR that and the automatic debit on the commercial bank to reduce the naira against the US dollar. Do you get? So looking at all of those points together is because the CBN wants to ensure that a level of stability is achieved in the FX market. But I think the focus should also be on the fiscal authority as well, to ensure that the real sector of the economy is up and doing, is efficient by addressing problems to ease of doing business. Because if those are not addressed, most of the CBN or the Monetary Policy Authority measures are short-term and they are not holistic. Some of these policies cannot even address major problems in the economy that has to do with real sector, like insecurity and a number of others.
Temitope, let's wrap up our conversation, and I like the fact that you brought into focus insecurity as well. Now, we're looking at the year 2022, and that's the year that precedes the general election as well. We are expecting an election in 2023. How do you see this tense atmosphere also likely tilt the pendulum in terms of how much we have coming into the country? So,
investors will look at so many factors. Well, they will consider what usually happened during pre-election years in Nigeria. I'm sure they'll do some kind of analysis to see how markets or economy agents react to those periods. And again, they will also look at who are the contenders, look at their philosophy and all of that. If the investors are not convinced about the next leadership, it will definitely dovetail into what will happen to foreign reserve in terms of capital importation. Currently capital importation is not even as attractive as it used to be in 2018 and 2019 levels. So they will look at the philosophy of the candidate that will contest for the election and see if they are pro-economy. Once they can ascertain that they are pro-economy, then they're going to bring their capital. All investors want is stability. They are not concerned about maybe volatility. Volatility is expected, but in the long run, you're talking about stability, that exchange rate will be stable, inflation will be predictable. They want predictability basically. So if all of those are ensured, then I think we're good for next year.
Well, we'll keep our fingers crossed and see how we ensure that we have a stable FX management in the country, and also looking at the fact that the economic climate also takes a better shape come 2022. We're already wrapping up the year 2021 and we can only expect better. Thank you very much once again for your time on the show today, Temitope Omosuyi.